Good afternoon, everyone. Hello, options traders, and actually for this video, stock traders. That's right, I was actually speaking to a stock trader the other day, somebody on a coaching call, and was showing him the benefits of rolling your call options up. And he said, well, that sounds like a really neat idea, but I like to hold shares of stock, at least in a lot of the positions, because of the dividends. So is there a way that I could continually kind of roll my shares up as the stock price rises? I'd like to get that downside protection, but be able to walk along with those increases. And it's a good question, but it comes from not understanding that calls are puts and puts are calls. And if that sounds confusing, and it does pretty much to everybody, there's a video in this forum talking about that. Calls and puts are exactly the same thing. It just depends on how we delta hedge them. So if we have shares of stock, we can still go about rolling it, we just do it in a different way. So let's do a quick review of what it means to roll your call options. Let's say that you buy a $50 call for $6. So you got $6 into it, $6 on the table, and $6 that you could potentially lose. The stock has now risen sufficiently high to a point where we can sell that $50 call and buy the $55 call for a $4 credit. So again, you would not be able to do this at the moment that you bought that call for $6, but later on in time, provided that the stock price rises far enough, you would be able to get this trade executed. To make things easier, this trade right here is actually a vertical spread. You could go into your broker's platform, sell the 50-55 vertical, $4 credit, put the trade in. It's just that easy to roll it. And when it's executed, notice you're going to close out your 50 because you were long and now short. Those cancel. And you're just left with the 55. You've essentially just swapped out the 50 for the 55. But now you own the $55 call for an effective cost of $2. Because you initially spent $6, you now brought $4 back, and so effectively you have $2 into the trade. Now notice that your initial break even was 56, and that's just found by the strike price of 50 plus the $6 price. We would need the stock price at 56 at expiration to break even. Well, after the roll, that changes because I own the $55 call at an effective cost of $2. So my new break even is 57. Notice that the roll caused me to increase my break even by $1. And that's because I had a $5 difference in the strikes, but I only got a $4 credit back. See, I used to have the right to buy shares at 50. Now I've got the right to buy them at 55. That's a $5 worse price for me. Makes me $5 worse off, but I only got $4 for it. So that's why it's increasing the break-even point by $1. So why in the world would we do it? Well, because the big reason is it reduces the risk. I used to have $6 into it that I could potentially lose. Now it's only $2. And so people say that's worth increasing this break even a little bit. And even better, it allows you to hold on for bigger profits because it allows you to continually reduce that fear of losses because you're reducing the amount you could lose. So here's what it looks like from a profit and loss standpoint. My initial $50 call was here, purchased for $6. That's the maximum loss. Our bend is right here at the $50 strike. So when I rolled it to the 55, I've moved from the red to the blue. And notice that the bend is now at 55. So the big effect, my main reason for doing this, was to increase this gap. I used to be able to lose 6 down here in the red. Now I can only lose 2. And that's because of that $4 credit that I received. But you can see that the red line has now been shifted forward a tiny bit to the blue. How far? That's your $1 increase. So again, what we're saying graphically here is that I'm willing to take this little tiny hit to the upside. I still have unlimited gains, but I've just increased the break even a little bit in exchange for radically reducing the amount that I could lose. But what happens if the stock continues to run, continue to roll? Maybe I can roll from the 55 call to the 60. Now I've moved from the bend here at 55, my old strike, to the 60, the new one, but something even better has happened here. because you can see my main motivation was to increase this gap right here, reduce the amount that I could lose. And yeah, I had to increase the break even a little bit. But something even better happened here, because notice I can't even take a loss. I used to have a $2 maximum loss. I pull in another $4 credit. Now I have a guaranteed $2 gain. And yet, take a look up here. I still have unlimited potential for gains. And that just means that I have completely eliminated the fear of losses, and I can let this run. And as it runs, I'm going to continue to roll. So once again, remember that calls are puts and puts are calls. This is how we're going to do it with shares of stock. If you have 100 shares of stock and you want some downside protection, like you get with that call option, you would buy a $50 put. And that is what we call synthetically equivalent to a $50 call. That's the key. We can create a call option by owning the shares. We're just changing that negative delta hedge with the put to positive by buying the shares. So here's what we look like with our long shares of stock. And notice that the risk is right down here. It's the unlimited downside. But if I buy the $50 put instead of the $50 call, I've now changed to this profile. Looks just like my call option, right? And the reason is, again, 100 shares plus the $50 put equals the $50 call. It's what we call a synthetic equivalent. So how would you roll the puts? Well, let's say that you bought the $50 put for 6, same scenario that we just looked at with the calls. But now if the stock runs up, you're going to buy the $55 put and you will sell your $50 put. But now you're going to do it at a point when it is a $1 debit. So notice when it's over, you used to own the 50 and you've now closed it right here. Those cancel and you're just left with the long $55 put. And so again, you can do this in the broker's platform by buying the 50-55 vertical spread. $1 debit. When that's done, what's your cost basis on the $50 stock? It's now increased by the amount of the debit. You own shares effectively at 51. So where's the hedge? Well, now you have a guaranteed $4 coming back. Why? You had the right to sell for 50 when you initially owned that $50 put, but after you do the roll, you have the right to sell for 55. It's now $5 better for you. See, when you rolled the call, it was $5 worse, but when you roll the put, it's $5 better. And so you're guaranteeing this $5, kind of putting in a $5 box here. You've guaranteed that you can increase that selling price by 5, but it only costs you $1. And so the net benefit is 4. So here's what it looks like. Here in red was your initial stock plus put, and then when you bought the 55 put, did exactly the same thing as the call. Here's the shift. You can see the red line shifted here because we had to pay that $1 for the put. Why did we do it? Because we decreased this amount by $4. That's the guaranteed $4 that we got by buying the higher strike put. If the stock continues to run higher, what do? Sell your $55 put and buy the 60. And you're going to go to this profit and loss diagram where once again, you cannot lose, and yet you still have room for unlimited gains. So the main key to understand is that you can do any type of a hedge that you want, whether it's with calls, puts, or shares of stock. You just have to understand that calls are puts, puts are calls, and once you understand that, you'll be able to create the hedges that you're looking for to stay safer in markets like these and still hold out for higher gains. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.